I'm a MAPS executive coach with KW. And so some of you may be KW, some of you may not. That today is really about real estate financials. So it doesn't really matter what brokerage you are with, whether it's commercial or residential. We're just going to be pulling up a P&L that we're going to be able to dive into and just talk to you today just through the lens of a coach and some of the questions that I ask myself, as I'm diving into P&Ls with our business, with our clients for that. So you may want to write down some of the questions. If you got a pen and paper handy, there is some things that I'll be putting out there that you'll definitely want to write down. Just FYI, those that are going to family reunion at KW, it's the end of March, or excuse me, it's end of February in Las Vegas. I will be a facilitator for one of the financials breakout sessions. It's called Slash Without the Burn. So that's what we're going to talk about. We've got some great speakers, great panelists there. If you guys are on here, I'd love to see you. Love to meet you as well. So for today, before I dive into the P&L, I would like to talk a little bit about the 4 reports as a coach and really as business owners that you should be really paying attention to. Number 1 is the profit and loss total income. That specific report, and I'll repeat it again, the profit and loss percentage of total income is really the report that I really pay attention to. Because I match that up with the MREA. Those that are not familiar with that, it's the Millionaire Real Estate Agent. There's a model in there called the budget model. And so this report that we're able to dive into today can really line up with what the MREA budget model looks like and see how you're doing compared to other businesses. So that's really report number 1. Report number 2 is a breakdown of year to date by month. And we'll dive into that a little bit today as well. I'll show you that report. In that report, I'm really looking for trends. It's also, I look for from a cash flow perspective, if there's a big expenditure, maybe at the beginning of the year or at the end of the year, just so we can pay attention to it, see if there's some jumps in lead gen or compensation. So I really pay attention to that report just for more of a trending, just to see what the business is looking like from the past year as we move forward. Report number 3 that you should really be getting or paying attention to is the balance sheet. The balance sheet is basically an overview of your business and how it's doing. And we're not going to spend too much time on the balance sheet. It's assets and debts or excuse me, liabilities, and it shows really the overall health of the company. And then the last report is the year-to-date detail expense summary. So if you're looking at the report, then you can go to the expense detail summary and see, okay, does this expense supposed to be in this category? What am I spending on? So you can really dive into a little bit more micro on that. So for today, we're going to spend our time on the year-to-date profit and loss percentage of total income and the year-to-date broken down by individual months. Now, when I start to go into financials, there's really 3 things that you need to know. Just really about these reports and about any business, whether it's real estate or if you're selling widgets or cars, it really doesn't matter. There's really 3 reports that you should really understand. The profit and loss here, what we're going to look at today, is more like the rear view mirror. If you're driving a car, it's the rear view mirror. It's the habits behind us. It's the things that we spent money on or invested in. So then we can actually pay attention to what we're doing moving forward. It's kind of hard to drive a business or a car looking at the rearview mirror. However, the rearview mirror of our business, which is our P&L, is an important piece of making solid business decisions in the future. The budget, if you're wherever you are on your financial journey today, or where you're at just in your business, if you're really good at the P&L and you visit that monthly or weekly, however often, I encourage you to move to a budget. Now, budget is really like the windshield of the car, where the budget is now you're starting to tell your money where you're going. You're looking at the rear view mirror based on the habits and the spending habits or the things that you're investing or expenses. Now the budget is starting to tell you, or you're starting to tell the money or your money where to go. So if you are at the P&L, move to the budget. If you're already at the budget phase and you're doing really well in that, I encourage you to move on to really financial report number 3, which is the cash flow analysis. That's really easy because especially in real estate, we can see our pipeline, we can see our pending commissions, we can start to see what monies are coming up. So then we can look at our P&L, we can look at the budget and just see where our cash flow is for that. So when I look at reports, everybody, I'm thinking in really those three terms: the P&L, the habits from the back. Okay, how are we budgeting? Where's our money going is the windshield, and three turns down the road is really the cash flow. So if you use that analogy in your business and you're nailing all three, congratulations. That's fantastic. You're running a sound business for that. So I just wanted to start off with that. Most important thing, if you get anything out of today, is have a date with your money, everyone. It doesn't matter if you have reports or not, or if you're not even looking at, however, if you're not having a date, whether it's weekly or monthly at the very minimum, I always encourage people to do it weekly. So then you start to see trends. I've got a lot of clients that have caught in fraud on that because they're visiting their money weekly. Just have a date with your money. I promise you, if you don't know what you're looking at that first several weeks, just keep doing it because the questions will come and you'll start to see different trends and you will start to ask yourself questions. That is awareness, everybody. So the first step to change, or the first step to getting better in your financials, is awareness. And just by having a date with your money is crucially important. Okay, so when I go into a P&L, before I pull this up here, and I know I'm going fast here and we're talking a little bit, and by all means, ask questions or wait till the end. When I go into a P&L and I'm looking at financials, there's questions that I ask. Number one, where can I potentially cut? Right. And I think you got to be careful about not cutting the bone or the muscle. However, where can you really cut the fat? Right. And so you just got to pay attention to it. So when I go into a P&L that look like I'm going in today, that's my mindset. Where can we trim? Number two is, where can I potentially reinvest back into the business that is going to give me more of an ROI, return on investment? So that's really the second question that I start to ponder as I'm looking through financials. And everybody, the only business here, if you're in a real estate sales business, the only asset that you have in real estate sales is your database. So when I look at the financials, I think, how are we setting up the business to really be more valuable? So I'm not talking about selling it or potentially selling it someday. How are we making this business more valuable so that if a buyer was to come and buy my business today, they would be able to see the profitability that's coming from it. So when I'm looking at financials, I'm always thinking, if I had to sell this today, is my business more valuable today than it was last month or the couple months before? So those are the really things that I come into a P&L. So just I wanted to share that with you today, of some of the mindset, and as we start to talk through this sample P&L that I'll be pulling up for that. Any questions on that, or any thoughts before we start to share my screen and start to dive into this today? Nope. Okay. Again, if you've got questions, throw them in the chat. We'll be monitoring for that. And so it sounds like, can you guys hear me okay? You guys can hear me okay? Okay, awesome. Okay. All right. All right, let me go ahead and share my screen. And we are going to dive into the P&L. Okay, this is can everybody see that? Yes? Thumbs up? Yeah, okay, perfect. Okay, it's a little weird when I'm sharing my screen. It's kind of hard to see if you guys can see things. So this is a financial report for today. We've obviously taken everything out, any personal information, any proprietary information. We're just using this as a sample, and we're just going to walk through the business. And I've highlighted some things, and we're going to talk about a few things through the highlights, and maybe some questions to ask, maybe some tax benefits. Again, I'm not a CPA or a tax advisor. However, I know enough to just ask the questions to the CPA. And so when we start talking about some of those things, make sure you write those down and take them to your CPA as well, and just get good advice on that. Now, there is a difference between a CPA and a tax advisor. A CPA can be a tax advisor, and I encourage that. A CPA is like an H&R Block or anything like that. They just push paper. They don't advise. Everybody on this screen in the business of real estate should have a tax advisor, and you should really be meeting with them at least once a quarter, either that or at least twice a year before tax time, so then you can start planning for that. All right, so today we're going to talk about the profit and loss percentage of total income, as you can see on your screen here. And then I'm going to scroll down here a little bit to the second form that we're seeing. It's going to be a little bit hard to see. However, I've highlighted some things just to show some of the things that I'm paying attention to and I'm looking at. Again, when I look at this this profit and loss broken down by months, I'm really looking at the trends. Like, for example, the admin, and I'm just using this as an example here, where the admin could be a you got 6,000, you've got 6,000 here on one, and then you've got 2,000 the month before. So again, those are just things that you really want to pay attention to, ask yourself questions for that. And so that's why I really use this form on that. Okay, so we've got two forms here. Slide this over. We've got two forms that we're going to be looking at today. We're going to stay on this particular document that's in front of you, and then we're going to toggle back over, or toggle, I should say, toggle back over to the MREA budget model. Now, those that don't understand this or haven't seen this yet, it is in the MREA, which is the Millionaire Real Estate Agent book, or at Kelwood, we call it the Red Book. And surprisingly enough, I see a lot of people not understanding how to use this. And so it's a real simple form. This is the best practices on what businesses in real estate are doing based off the categories. Okay. And so how we're going to use this today is the GCI that we have that you see right in front of you, which is 976,261. The GCI on that, we're going to use basically the $1 million here that you see, the $1 million mark here. And what we do is we take that, and everything that we do today, or we compare it to, it's going to be in this column all the way down here, right under $1 million. So wherever you are at in your business, on the GCI, gross commission income, that's what you want to start comparing your business to. So if you're at 340 or close to, you'll want to use this column particular here. If you're at over 2.5 million or so, you'll want to use this column, and so forth and so on. So a lot of people don't really understand it because it can be a little overwhelming just with the percentages and numbers on the page. However, keep it super simple and just follow what you are using in your GCI. Okay. So for example, a couple things that I highlighted and I really pay attention to is the GCI and the cost of sale. Now I'm going to take just a quick second to talk a little bit about the cost of sale that you see here and the GCI, which is gross commission income. Most people, not clients at your bookkeeping partner, however, people that are on here that are not using our services, or you may be using another bookkeeper or an accountant, which is fine, they're probably having an accountant P&L, which they're only recording this piece of the P&L. So whatever gets deposited into your account minus all the expenses, and then they're printing off a P&L, they're handing that to their tax advisor or their accountant, and then that's how they're able to do their taxes. Perfectly fine. However, if you're wanting to take off your realtor hat and put on your CEO hat or your business hat, you really have to track the numbers above this, which is our cost of sale and our GCI. So for example, let me give you a quick example. So if you have a commission check, I'm just going to use a round number here, just for example here. If you have a gross commission check of $10,000 and $3,000 is taken out for cost of sale, which is a cap or a royalty or a referral fee or an agent's split, then it's being recorded here as gross profit. So $7,000 is left over for that. An accountant P&L is only recording that $7,000. It's not recording the $3,000 that can fall up in here. Very, very important. And when you look at this budget model and you see all these percentages right here, and let's just stay with the 1 million. You see all these percentages that I'm highlighting on your screen here. This is 1 million in GCI. So gross commission income, this right here at 976, 261, not this. Okay, big difference. So a lot of people, even I've talked to leadership before, they're saying, no, we have an MREA budget P&L. Say, okay, great. Are you looking at your DAs? And for those that are not Keller Williams, it's your disbursement authorization, or basically what comes out of your commission check. And those leadership are even saying, no, we're not. Well, then you do not have a budget model P&L or a business P&L. So every time I do this, I think it's really, really important to understand the difference between a business P&L and then an accountant P&L. So if you have some further questions, throw them in chat or bring them up towards the end as we go along here. So, okay, so I'm just going to cancel these out just to make this a little bit cleaner. Actually, I'll leave that here. So a couple of things that I really pay attention to is how's the health of the business? And in our model, leads, listings, leverage, we want to stay about 60% listings, 40% buyers. At the very minimum, we want to be about 50-50. 50% listings, 50% buyers. I've seen a lot of P&Ls that are heavier on the buyers than the listings. I promise you, you will be working harder and making less, because it's just harder to put buyers under contract. You got to go through inspections and appraisals and those types of things. Your business is vulnerable if you are a lot higher on the sales side than you are the listing side. So as you can see in this particular business, it's a little lopsided, not bad though. So you got 47% of their income is coming through listings, and then almost 53% is coming through buyers. If I was their coach, and I'm not, I would be working on how can we generate more listings to really work towards that 60-40 model, 60% listings, 40% buyers. So right now, how things sit, this looks pretty good. It's a balanced business for that. So then I move on to the cost of sale. And everybody, I could spend an hour just in the cost of sale. I will tell you, and just because I've seen thousands of P&Ls, where people miss the mark is they're not tracking their cost of sale. Now, what is a cost of sale? It's really four things. Number one, it's your Keller Williams cap. So if you're not with Keller Williams, what's a percentage your market center or your brokerage takes from every check? Okay, so we call it the cap here at Keller Williams. It's number two, it's your royalty. So this goes to Keller Williams. So if you're with another brokerage and you pay a royalty of some sort that's coming out of every commission check, this would show up in your cost of sale. Now, what's not on here yet, just based off of this, there's two more that are pretty much, there's four categories. There's the cap, the royalty. If you have any team members, buyer's agents, listing specialists, maybe an ISA that gets a bonus of every closing on there, they would show up under the cost of sale. So the GCI would come in, the cost of sale of whatever that split is with that agent, that would show up in the cost of sale as an agent split. So that's number three. Number four is any outside referrals. So if you're in California and a Florida agent sends you a referral of a buyer or seller in California, and you work with them and you pay them that 25% referral fee, that too would show up under the cost of sale. So think of it this way. It's not a cost unless it becomes a sale. Now, where I see people get tripped up a little bit is they put photography in here, or staging, or maybe a sign for a property if it's a commercial building or so. That does not show up in here, because you can go ahead and do those things, pay for those things. It's really to enhance the listings, and you're still paying for them even though the property hasn't sold yet. So that does not show up in here. Couple anomalies that I've seen throughout the years is the concessions. So if you have some clients or sellers and buyers that are just not coming together on price, or excuse me, you're almost to the closing table and that $200 microwave, the seller's not going to sell it because they don't want to fix it, or the buyer doesn't want to buy the house because of the $200 microwave, and you're paying that out of your pocket just to get the deal done, that would show up in as concessions under the cost of sale. ISAs, if they're getting a bonus per closing, it would show up as a cost of sale. If they are getting paid a salary or an hourly, that would show up under compensation. Okay. And then the others that I've seen is E&O insurance. I've seen E&O insurance attached to every closing. So I've seen that too would show up in a cost of sale. And then I've also seen some MLSs throughout the country where they charge a small percentage of every closing of the, or every transaction for that. That too would show up in the cost of sale. Okay. So I really pay attention to this. 90% of your expenses, everybody, is really wrapped up into this cost of sale. And so if you're not nearly as profitable as you want to be, or you're struggling with profitability percentages, this, as a coach, this is the first place I'd go. I'll give you an example with a client of mine. We spent almost 2 months just in the cost of sale, really figuring things out. Agent splits, they have a large team, and really working to get that cost of sale down. Now, there is a model that you'll want to write this down if you haven't heard this yet, is even though we have the budget model, which is everything that you see here, a general model is 30, 30, and 40. Okay. It's 30% cost of sale, which is basically this number here, 30% expenses, 40% profit. So that is a general 30,000 foot view model to really work within. However, because we have a P&L, we're starting to drill down on the budget model. So as you can see, everybody, we're at $1 million. The model shows the best practice is 25% of cost of sale. This particular P&L is sitting at 4.72. Great, right? However, the only question behind that is you're making a lot of money. How's your lifestyle? Again, I don't want to judge anything. As a coach, we're not in judgment here. We're just here to ask questions. Are you working a lot? Are you working 7 days a week, 8-hour days, or 10, 12, 14-hour days? So if that question is yes, then we have some room to potentially hire another agent that can offset some of that. And going back to that model, leads, listings, leverage. As a coach, we'd be focusing on the leverage piece, maybe hiring a showing agent or a buyer agent or listing specialist. We would really dive into this. So this is great, right? So it's fantastic. It's on the low side. However, these are just some questions I would be asking them if I was their coach. Okay, one of the things here, and again, I have to look at this. I'm like, wow, the administration is making a lot of money. It's almost 31%, 31.93% of the total GCI here, a lot. Now, if you come over here, actually, excuse me, we'll just roll down here, see employee retirement that I've highlighted, and we come down to here, we're seeing total compensation is 60.10 or 586,765. Now, you're probably thinking, whoa, they are really, really over leveraged. Not the case. I mean, you really got to dive into you got to dive into the business. And if we look at the model's best practice, we say, gosh, compensation really should be around 20%. So let's dive in a little bit deeper. Now, I know the backstory on this particular person or client, business, whatever, is that this is a family member for this. And so that might be fine. That might be part of their tax strategy with their accountant, is to pay a family member a higher salary for that. So then they can get potentially some tax benefits on their employee retirement plan. So this could be a really good thing, right? Based off of their taxes. However, if I'm looking at it through a business sense or through like admin, that's maybe a non-family member, non-spouse, or whatever that looks like, then wow, we are way, way off. And we really need to talk about that. Now, of the P&Ls that I've seen throughout the years, this is really number 2. So cost of sale is off. That's why they're not nearly as profitable or as profitable as you want to be. This would be number 2 that I would come to look at, is the compensation. How's the compensation plan? Are we over leveraged? Are we getting a return on investment with those people that we've hired for that? So again, there's a lot of questions in this for that. However, the backstory is that this is a family member, and it might be fine. It might be okay. However, it is going to affect the bottom line as we start working our way down in the P&L. Okay. And then another thing that you probably see on here is team appreciation meals. you might want to put this under like people, I've seen it like under supplies or under some other things. It really falls under compensation. So we really want to pay attention to some of the benefits that we're doing to the team, maybe lunches for the team, or maybe team events, those types of things. So it really falls under there. This is where I see another miscategorized for that. You can see the admin here. Now, this is an admin or this is a family member. This could be an admin or a TC, or they have a TC right here, or an executive assistant or a VA. These are just things I would dive into. What's their job descriptions? We've got a salary here. We have a salary right here. What's their job descriptions? And start really deep diving down in on that. Is it something that we could potentially get away from? Could we potentially cut this person if this person can handle some of the workload? Or could we potentially cut this person if the transaction coordinator could handle some of that? So again, these are just questions that I'd be asking as I'm looking through the P&L. And again, going back to the mindset of cutting, how am I making this business more valuable? If I had to sell it, could I present this P&L and potentially sell this business? Again, those are the things that I'm processing through in my mind. Okay. So number three, so if business is not nearly as profitable, the third thing is I start to look at is lead gen. So if you want to write those down, if you're not nearly as profitable as you want to be, it's chance 98% of the time, it's going to be cost of sale, compensation, or lead gen. It's going to be one of those three things. Now, I've seen P&Ls where the business owner or the rainmaker owns a building, and then they charge their team, or their team pays rent to the owner at a pretty high rate. That starts to bring things down. That's okay. It's a tax write-off. It's an investment. So there's definitely some things to pay attention to. However, it's going to be those three. As you start to look through the P&L on here, the listing, or excuse me, the lead generation, you can see our categories start to line up. We went compensation. Now we're into lead gen. Listing management, 3.4. Prospecting, 7.8, a total of 11.2. So over here, we're looking at 7.3 to be really within model, right? Again, this is just a way of measuring your business to other businesses or best practices. It is not the silver bullet here. It is just not. However, if you want to run your business like the MREA budget model, knock yourself out. I've got a lot of teams, a lot of businesses that I coach that are running in the 20 to 25% profit or net income of that, and they're happy. So again, this is just a model to measure your business against. If you're happy with your profitability, you're happy with everything that's going, and you're getting a return on your lead gen like you should be or could be, good for you. Awesome. Again, these are just models. So for the lead generation on this particular model, we're looking at 7.3% to be within model. Now we come back over here and say, oh my gosh, it's sitting at 20.06%. Now, again, if I was a coach, their coach, I would be looking at, and I put a little note here, is, are they getting the ROI that they could be on their business, right? The biggest, on a P&L, this is really an expense. In a business, this is really an investment. So compensation, we invest in people. Lead gen, we invest in our business, right? So I'm highlighting this as 15.18%, right? So we may be sending out mailers. We do a nice job on the client events. I love seeing that because our database is our biggest asset in the real estate company. That's fantastic. However, I would interrogate this, interrogate. Are we really getting the calls? Are we getting the business on it? And we may be. If that is a 4-to-1 and we're making money on this business here, you can see up here 976, and the majority of our lead gen is color print or mailers, those types of things, and we're getting a 4-to-1 and we can really prove it. Awesome. Great job. However, if it's less than a 4-to-1, it starts creeping down to 3-to-1 or 2-to-1, then it might be something to maybe pull off some of this investment and maybe move it to more client events, or maybe move it into an area that we can get a better return on. Now, those that maybe not understand the 4-to-1, what that represents is for every dollar that I spend or every dollar that I invest, I'm looking to get $4 in return. So it's an ROI. So when I put this out here like this, where it says, are we getting a 4-to-1? At least I was, maybe not. Okay. Are we getting a 4-to-1 return question mark? So this would be a place that I would, as a coach and as a business partner with our clients, I would sit in this space and really analyze this. Are we getting a 4-to-1? Ladies and gentlemen, this would be the third really spot. If you're not nearly as profitable as you want to be in your business, this would be the third place to look at for that. Now, here's another thing to pay attention to. I've seen a lot of companies and real estate professionals really invest a lot of their money on their clients. That's really the best ROI that I see as a coach. I've seen 8-to-1. I've seen 10-to-1. I've seen some clients have a 50-to-1 based off of what they're doing. That is typically the biggest return on your investment, is pouring back into our clients for that. Now, I have seen some businesses that run more of a lead gen model or internet lead gen model. It's great as long as you're able to track the business, as long as you have a great follow-up system in that business to capture those leads, a speed to the lead. And then the only thing I would say about that is concerning is, or potentially concerning, is that that business is relying on a third party. It's relying on the internet to generate the income in the business, where your client events or database, it's your people, the people that like you, love you, and trust you. They're going to generate referrals. Internet, if they put their name in one place, they're putting their name in 10 different places. So at that point, if you have that kind of business and it's set up awesome, and are you really making sure that you're squeezing all the profitability out of that one line item for that? If you are, amazing. If you're not, it might be a time to reevaluate or reinvest in some areas of your business. Okay, so we're saying here it's at 20.06. Again, we don't know this business. These are just questions that I'd be asking if I did, and just say, okay, where are we at? What does it look like to get it down to 7.3? Well, here's another thing too, everybody, is we are the hub of all real estate transactions in our local community. We know plumbers, electricians, home inspectors, lenders. When people go to buy or sell, a lease, in some cases, the chances of them calling a real estate agent is really, really high. And so we have relationships through the community. So if we're investing money into lead gen, we could be looking at offset some of those investment dollars to some of our vendors. So if you are not using some of your vendors to offset some of that, that is one way to generate more profit or put more money back into your pocket. And you're also building relationships with those vendors in the community. So this would be one way, is like, okay, are we really investing 148,000, or could we get other vendors to pay for half, a quarter, all of it, those types of things. And one of the questions I always ask, and it's a really hard answer, is there a way for us to zero out the lead gen? Zero it out. Can we do that? Imagine in this particular business that we would generate $195,000 back into our pocket, a big bump into the profitability. So anyway, those are just things that really pay attention to on the lead gen. I see some questions coming in, so we'll definitely come back to those questions. We're about another 10 minutes in, another 15 minutes, and we'll open up for some questions. Okay, everybody? Okay. All right, so we've got the lead gen, so we're a little high on the compensation. We should really take that and put that into the owner or family member, a bucket, if you will. So it really doesn't. So if we really took 31.93 off of 60.10, we would have like 29% for that left over. Now, also the employee retirement is almost 20%. So between the two, it'd be 52%. I'm just kind of rounding a little bit. So if we took 52% off of this, that would leave us 8%. If we come back to the budget model under compensation, we're right there, right? So again, I would just question, what are the job descriptions? Is there anything that we could really offset, or hire more people, or what does that start to look like? Because technically, if it wasn't a family member or whoever, I would just say we could leverage a little bit more. That could go into more owner compensation. So as a business, we have room to hire more people if we choose. However, on paper, we don't. So you really got to dive into it, ask yourself the questions around that. Okay, so I just put some couple things in orange as we went through. Storage, maybe it's signs. Again, I'm not here to judge. We're just looking at that. Could we offset that with another tenant? Is it the storage big enough where we could separate the building or the whatever that looks like to offset some of that with another lease? So again, these would just be questions that I would ask the client if we could potentially do that. And that right there is 1.16, or excuse me, 1.66. We come down to occupancy, we're sitting there right at 2%. Okay, so pretty good. Everything else you can see, everybody, is really pretty low. It's around that 1, 2, 3% for every other category. However, the lead gen, the compensation, everything above that is more of the bigger numbers. So as we start to come through this P&L, you can see it's 1.6%. Coaching, it's always interesting to see our salaries and what we do on the P&L. It's a return on investment as well. It's an investment in yourself. I'm obviously biased as a coach and as a business owner. Investing in yourself is the best return on investment. So that's sitting around that 3.54. And if we go back to the budget model, we're looking at 2.3. So just a little bit higher than what the budget model is saying. However, I see on a lot of P&Ls anywhere between 3 to 5% is that. So it's really in line with a lot of the P&Ls that I see throughout. And as you can work your way down through, we got supplies, communication, technology. Another thing I see sometimes, everybody, is sometimes communication and technology is CRMs. It's CRMs like Boomtown or Commissions Inc. or Crexy or some of these things that help us run our business. It is not technology underneath supplies and office supplies or communication and technology. That would fall under lead gen. So that CRM that you're paying for, whether it's 500 or I've seen some at several $1,000s a month, that helps generate more business for us, that would fall under the lead gen part. So I do see a lot of people putting their CRMs or any type of lead gen things that they do to generate more business under here. It is not. It would fall under the lead gen. Now, as you can see, we got another 10 minutes left here. As you can see, we've got 5.73% profitability. And so at first glance, like, whoa, it's not very profitable. However, if we go back to the compensation, see the family member that's getting that's another 50% back into this particular business. So if I was going to sell this business, we would have to take that family member's compensation out and we would want to put it below the line. And when I say below the line or above the line, I highlighted net operating income. So anything is what we call above the line is above this, which is up here. And then anything below the line is below net operating income, which is down here. And this is your rainmaker. This is your charitable contributions. These are things that for you specifically as an owner, really want to put it below the line, because I want to look at the business, how the business is doing without you. And I want to be able to see the business, what the business is doing with you. Now, my niche in coaching is to generate, to work a 5-year plan, where I call it a 5-year, you can call it a 5-year exit plan. I call it a 5-year option plan, where we're making enough money, we're generating enough passive income that you have the option to work. That's what I work on. That's what I coach to. So in order to be able to do that, we've really got to separate the rainmaker and the owner with the actual business to be able to start working that way. I've got several clients where we're starting to transition that. And now we're going to start putting their salary, in this particular case, 330, we're going to start putting it above the line into compensation. So then we can start to feel what it looks like when we go hire a potential listing agent or CEO of the business to be able to step out of the production side of the business. Now, that's a rabbit hole to go down. However, that is why I really look at it and separate the two, so I can see the business without the owner and see the business with the owner based off of that. Okay. So as we come down here, we're looking at net operating income. We look at the model here. We should be around that 39%. Again, I've seen companies at that 20, 25%, and they're super happy with that. Good for you if that's you. If not, the model says, hey, we should really be at that 39%. I'll be honest with you. I coach a lot of people over the $1 million mark. It's a challenge. I mean, it's a challenge to hit that. I usually see between that 20 and 30% profitability. I have several clients that are above that. However, it can be a challenge, especially if you have agents or those types of things. It can be a challenge on that. Now we start looking at the compensation. Now, one note I did put out here, I'm not a tax advisor. I just know it a little enough. And this is a question that you should be asking your accountant is charitable contributions get less of a tax write-off than if it's a sponsorship or promotions. So if you're just writing a check to a charitable contribution, how could you work that into being a sponsorship or promotion? Because this gets more of a write-off on your taxes. Now, that is a question to go ask your accountant. However, just by changing up some of the categories can make a difference into your P&L for that. Okay, so I just highlighted that, see that. And then if we come down here, we've got 5.73. Now we're adding the rainmaker and the owner back into the business. We're at a negative 53.27. And on the surface, if you're looking at this, you're probably thinking, oh my gosh, they're not making money. However, the backstory is they're doing really well, right? So again, P&Ls just tell a little bit of the story of what the business is looking like. However, there's some things based off the person's business where we could take it at some point. If they wanted to generate or get themselves out of the business, then we would look to knock this thing down, the salary of the big salary up front here. So again, it's just how to look at the business, how to look at the business if I was to sell it today. And so somebody's not going to pay $400,000 or $500,000 to an employee with inside the business for that. The only thing that I'd also question on is just the salary amount. Again, just make sure that you've asked your accountant. If your accountant says, hey, you really should be taking a higher salary, just question that. There is different taxes based off of the business. Businesses get taxed differently than incomes. And so just really work with your accountant on, hey, is the salary, should it be as high as it should, or could we lower that? And what's the tax benefits of running it through like an S Corp or an LLC for that? Again, I'm not a CPA, I'm not an accountant. These are just some things that I would ask for that, because you are paying a lot of income taxes on that. And could you be lowering it? Now that's a double-edged sword. I went to try to buy some. I try to keep my income personally down as low as possible, just for tax benefits. However, it's sometimes hard to buy income properties because it's just on paper, it doesn't show I make a ton of money, and here on paper, this person and this business makes a lot of money. So they could probably borrow and go buy investment properties, and maybe that's their strategy in long term. So again, there's zero judgment on this. It's just some things to have conversations around and talk through. Okay. And lastly, we got about another 4 minutes or so. I want to just touch base on this, and we'll start opening up to questions, and I'll get the questions are starting to fire up here. So good. I'm glad to see that. All right, so this is a little small here, and I apologize just on the screen. However, I did highlight some things. The biggest thing here is you can see the Keller Williams cap. That was one big hit, where then it was a cap on the second month. It might be, if you're running a budget, you might want to just, if whatever cap it is, in this particular case, it's 37,000 over here. You may want to just budget it monthly instead of one big hit through the year, just so you can look at cash flow, or maybe work with your market center to see if you can spread that out so it's not one big hit. Now maybe you like that, or that's fine. To me personally, I would want to see that spread out as long as possible so it's not a huge hit, and it just becomes more consistent so we can see that. However, again, if you're happy with paying it off first, and you're what we call overcapped or capped out, good for you. These are just more preferences. Just some highlights here. Administration saw one go high up. It was down a little bit, 27,000, jumped to 41, and then came back to 28 again, and then 5,000 and 5,000 throughout on the administration. And this could be just taking money out, or payroll, or however that looks. These are just things that I highlight when I look through the monthly, and you can see this is probably a tax grab here, that you can employee retirement, you put money in a retirement, as long as it's the advice of an accountant and that's what they're saying to do, great. So again, that was a big one right there. And then I just highlighted a couple things down here, just seeing the inconsistencies for the net operating income. And then I also highlighted, as you can see on the screen, maintenance and repairs. We're seeing some maintenance and repairs. We took a big one here in April, and then it kind of died off a little bit. So what is that? How can we button up our systems, our processes? I'm guilty of maintenance and repairs. Apparently, I like to pay for things for clients, and So I'm guilty of that too, just to make the client happy, or maybe it's part of your marketing plan, whatever that looks like. These are just ways that you could trim another $12,000, or maybe offset it with a vendor, or get a client to pay for it. So this is just ways of doing that. There's two things about this, everybody. There's the business is really simple. It's either increase revenue or decrease expenses. It's really that simple. And if you want to grow your money, you got to know your money. And for today, really going through the P&L is just the steps of awareness to really understand that. And so it's really not about how much money you make sometimes, it's about how much money you keep. And in this particular business, they're doing really well. Up here, they're 975,000 or whatever that was. What's maybe some of the tax strategies to really drive down the taxable income? So you're paying less in taxes, obviously legally, and maybe you're using some of that money to invest. Then that's just a whole different discussion on cost segregation, bonus depreciation, those types of things. So, all right, I know I threw a lot at you today. We're wrap up. I will start to stop sharing my screen here. And what I'll do is I'll just start opening up to questions. And if it's okay with you, I'd like just to start answering some of these questions in the chat, and then maybe open it up for discussion, if that's fair with you guys. Okay. All right. So can we get that doc? I'm not sure. Okay. So that was just my microphone here. AI. Why would listing commission and sales commission show up under cost of sale? So sales commissions or listing commissions, if it shows up under cost of sale, it's usually a referral. So whether it's a buyer referral coming in, you're paying out of 25% for a buyer referral, or maybe it's a referral coming in and you're selling that client's house, then that would show up as a listing commission or sales commission, because it's a referral paid out for that. If it is your business and it's your client and you're listing your sales, it would show up in GCI. And then whatever your agent, if you do have agents and you're paying that out of that check as a cost of sale or an agent split, then it would show up under that. Listing commissions and sales commissions, just a way to chunk it down a little bit more to see where the referrals are coming in from. So it's just a more detailed way of looking at that referral system. Is that the number? Oh, any questions on that, Stephanie?
No, I think you explained it. It just, when you were showing me the one you had, it didn't have it on there, so I wasn't quite sure what was happening.
Yeah, it's a great question for that. However, we just like to get more specific on what the referrals paid out are the sales commissions. Okay, is that number not the same admin's benefits? Lisa, can you tell me question go a little bit further? Not understanding the question.
Okay, you had pointed out something under, I can't see yours. I'm looking at my own right now, and I'm not sure I have the same thing, but you had the admin with that 311,000 or whatever salary.
Yep.
You went down below and you had right there benefits processing. Okay, contract labor. Oh, I see. It's below there. That 45,000 is contract labor, basically.
Yeah, or an admin, or like an admin in-house, or professional services could be under this. Yeah. However, the staff salaries is really in here, as you can see on my screen.
I was reading it upside down. I thought of that as benefits for that admin.
Got it. Okay, got it. Yeah, right. I assume it's the owner here, just with the large number. It could be an admin. If it was, I would want to see it closer to the admin line. However, yeah, that's just again how we're looking at that. Good question. Let's see. Why listing commission number? I'm looking at my preliminary YBP P&L, and my salary as Rainmaker is not below the line. Should it be? Yes, Lisa, it should be. So if your salary that you're taking a salary through an S corp or sole proprietorship, and it's consistent like a 1099. Now, this is not shareholder distribution. There's a difference. So if your business is paying you a salary as a W-2 or that, yes, as a Rainmaker, it should be below the line. If it is not, work with the bookkeeper to make sure that it's there.
So I should work with my bookkeeper there at your bookkeeping partners. We need to rearrange some of these things. Yes,
that's right. That's exactly right. And that's the partnership piece. That's exactly right. Yeah. I will say and I take shareholder distributions too. I pay myself a salary and take shareholder distributions. That shareholder distribution is going to show up on your balance sheet. And so it will not show up on your P&L. So that's why in the very beginning, when I talked about the third report is the balance sheet, how much is your shareholder distribution taken from that? Okay. Will this recording be emailed out? Jeff, that's to our team. We should be. Absolutely. We want to, our mission is to empower agents to financial freedom. And this is the first step to that. So we're here to help you a little bit. All right. Jose, you got a hand up. Start opening up for
So I
questions.
guess one of my questions was going through the P&L, and I'm working with you guys too, and you guys been cleaning up the books and doing that kind of stuff, transitioning. But there was a lot of categories I didn't even think of or how to name things. Do you guys give us like all these categories because when I was going through it and filling it out with the people at your company, they would just ask me what it was, but there was a lot of things I didn't even think about naming it that way, or it would fall into that category. So how do we get more in alignment with that?
Yeah, great question. I think that's just asking more questions around it. You got a lot of moving parts. I don't know your business, Jose. You maybe have a lot of expenses or income coming in, or maybe a bigger team. So there's a lot of moving parts. It's really keeping with the fundamentals from a tax perspective. That's where you got to really lean into your accountant on that of what's the best benefits for categories like charitable contributions, right? I think it's like 6 to 10% tax write-off, where if it was just under sponsorships or promotions, you would get more. So those are just some little maybe hacks to make sure we're categorizing things properly. So yeah, work with your bookkeeper. I'll tell you one thing that we're very passionate about. We train everybody in our organization to be able to give this type of presentation. So everyone, every week, has been able to do this. We really dive into a P&L. So really ask those questions, Jose. And if you're not getting the answers, by all means, call me. I'll be happy to work through that, or email me. That's what we're here for.
Awesome. Thank you. Appreciate
My
it.
pleasure. Yeah, you bet. All right, Ozzy. Good to see you, man.
Good to see you, Kyle. I got some like three real quick quick fire questions. Number one, are you able to disclose the city and the units that this team operates, just to kind of see that side and get the context for those numbers a little bit?
Yeah, I probably wouldn't. However, honestly, I don't know.
Okay.
So my team, I just told them I don't want to know who this team is. I just
Mhm.
want to be able to look at it and be able to look through the lens of what I would be talking about if I was looking at this.
Okay, thank you. Second question is, you said it would be nice to get the lead gen cost zeroed out with some of these partners, vendors, service providers that we share a lot of business with. Is there
Yeah.
anything as a business owner that we need to know with regards to RESPA? What's your experience with that, with the
Yeah.
whole RESPA being a violation?
Yeah, great question. It's just a question that I ask myself. The chance of that actually happening are probably pretty slim. I think the RESPA is, 50/50, where you've got to invest 50%, for that. However, there's ways with client events. What I've seen that agents are doing are, let's just say, I'll use one for example, like Commissions Inc., right? So Commissions Inc. is a CRM, if you're not familiar with that. And it's usually somewhere around that $1,500 to $2,000 a month. Well, I've seen title people, I've seen loan or lenders pay for half of that, right? And so Commissions Inc. will bill them from there. They're not billing through the agent, they're billing from their platform. So they're billing let's just call it a lender. They're billing out half of that to the lender, and the lender is paying Commissions Inc. So those are some of the things to, just really pay attention to if you're looking to offset some of that. Again, you want to read your local RESPA violate, you want to look at that and make sure that, talk to your broker, making sure everything's above board. It's just a question I like to ask is, are we really paying attention to the vendors that want to do business with us? And quite frankly, they probably don't have the advertising budgets that we do. So just by putting their logo, their information in some mailers or online, or it's helping their business too, right? So it becomes a partnership, on that.
Oh, that's so true. I'll get familiar with my RESPA, and then I'll
Yeah.
talk to my. And then the last question that I have is the employee retirement line on that P&L. What does that mean?
Let me pull that up here.
Yeah.
Employee retirement. So like a 401k or
Okay.
like like a Roth IRA or something. That's what I'm assuming is some form of stocks, bonds, or wherever they want to park their money for their
That's what I
retirement.
was thinking too. I just wanted to see if that's what it meant. Okay, perfect.
Yep.
Thank you, Kyle.
Oh, my pleasure, Ozzy. Yep. Any other questions you guys got? Any nuggets, any takeaways? We've got 4 more minutes before we wrap up here. Any thoughts, comments, takeaways, something that you're going to implement that you'd like to share with the group? Jose.
Well, I mean, the takeaway was just, just the P&L in itself and just how much it can tell you about your business and, and being a real estate agent for a while and not treating my business like a business when you see the breakdown, even just knowing the splits between your buyers and sellers. And I'm guilty of it. I mean, hopefully everybody else is probably not, but
We are.
knowing even the split between your buyers and sellers, like, most of the time we're on the grind and we're just in the business so much that we don't look at the business, and you just trying to drum up new business and close more business, and you're not really paying attention who's the buyer, who's the seller, as long as you're closing deals and
Right.
thinking about, like you said, creating a life that means something to you as opposed to just a dollar, because you can make millions of dollars, but if you're not really creating a life that's worth something, and the people around you are just kind of moving away from you because your job is all you have, then, or your career, it can really tell you a lot about yourself too, just looking at your business and what's happening there and how you can improve your life as well as your business. So that was my main
1000%.
takeaway. And then I did have a question. When you were going through there, you were talking about trimming things, and you talked about the balance, being more of a listing side and buyer side business. Where do you think you'd want to reinvest your business the most in? Is it systems and people? And this might be a coaching question, but I'm just curious from your, yeah. So basically, is it leverage or is it leads? Because there becomes a point in time where, you might not have a lead problem, you might have a systems problem, you're not capitalizing on leads.
Right. You're
So
absolutely right. Yeah.
where do you think the foundation and the best place to reinvest is in?
Yeah. I think the first question is, do you have a leads problem or a leads conversion problem? If you're working to get more listings, look at your pipeline, look at your database, because your database is going to, if you're not, if business, and this is for everybody, your database is the only asset in a real estate company. Being intentional with growing it and being intentional to consistently communicate to it, your business is going to grow more over time, right? So if you're looking at reinvesting, that would be a place, like I said earlier, just to be that. So if you have a leads problem, that would be the focus. What do we have to do? Where do we need to reinvest to generate more leads that would generate more listings? Now, if you say, hey, I've got all the listings, but I've got a huge pipeline, then you probably have a conversion problem. So then at that point, is it a person? Is it a system? What's our follow-up look like? So then you start to get nailed down to that. And if you have both problems, then there's nothing that 20 real estate conversations a day can't solve.
Okay.
Yeah. Bo, go ahead.
First off, Kyle, great information. I appreciate your time
Awesome.
today.
Yeah, good to see you.
Yeah, likewise. Does your bookkeeping partner have any preferred partnerships as far as setting up, with tax professionals or those, retirement, Roth IRA, 401ks, and things of that nature?
Yeah, we do. We have, we can go offline with that, Bo. We do have some people that we've vetted. They're very real estate specific. So they really understand that. And we can definitely advise on who some of those people are. We just really wanted to stay out of the tax game so we can do our one thing, which is bookkeeping, for real estate professionals. So we farm that out to a really couple good companies for them.
So we just reach out to our contact there with your
Yep.
bookkeeping, and they can set that up.
Yeah, we can have Amy. Amy's on here. We can have her reach out to you. Yeah, I think Sig is on here as well, or one of our team members can reach out to you, Bo.
Awesome, appreciate it.
Yeah, my pleasure. Okay, we're right on the hour here. Any other questions, thoughts, comments before we wrap up here?
No, thank you for today, Kyle. I appreciate
Hey,
the
thank
ahas
you
and
guys for coming. Yeah, absolutely. We'll be doing this once a month. So if you're just wanting a refresher or come back through some questions throughout the month, write them down, bring them to us. This is just super important through education and and helping you guys and just really empower you to financial freedom. And this is the first place it starts. So, all right, everybody, I sure appreciate the opportunity to be in front of you. Thank you for being clients of ours. If you are, we really appreciate you. Have a wonderful weekend. Talk to you soon. Thanks.
Thank you.